You're losing money in crypto, but not because the market's rigged or the market's crashing, but because there's a barrier between you and the lingo being used. If you're ready to learn, watch this video all the way through so that I can break down these terms in English. This video is for beginning and intermediate traders. I'm not using math or charts in this, I'm just explaining vocabulary. Our first term is market cap. Market cap is one of the most misunderstood terms in crypto. All it is price of the coin multiplied by the total coins available. A coin can be cheap but have a massive market cap, or it can be expensive but have a tiny one. This is why a coin at $1 isn't automatically cheap. If the market cap is already huge, then there's way less room to grow. Our next term is liquidity. Liquidity is just saying how easily you can buy or sell without changing the price. A high liquidity pretty much means that there's a lot of buyers and sellers, but a low liquidity means you're stuck. If a coin has low liquidity, then on paper you might be up really big, but if you sell, you're gonna crash that price. Low liquidity is what people get trapped by in crypto. Carrying over, our next topic is exit liquidity. Exit liquidity is pretty much when the early holders are selling to the newer buyers. So pretty much if you're buying into something after the hype, you're pretty much the exit liquidity for someone else. You should be asking yourself 3 questions. Who's buying into this? Who's selling into this move? And why should I do it now? If insiders are selling and retailers are buying, that is the exit liquidity. Our next topic is already pretty well known, but I thought I'd cover it anyways, and that is rug pulls. Rug pulls are when the creator of a coin drains the money out and just disappears. Rug pulls happen when the team is anonymous, the liquidity is not locked, and the promises they make are way too good to be true. That's why you have to check how much of the coin is owned by the owners themselves, because if that percentage is very high, they control your future with the coin. An example of a rug pull I think would be USOR. They just built up over a month of hype, brought the coin up to a great high, and just vanished off the face of the earth. Now let's talk about coins versus tokens. A coin is the main currency of its own blockchain. Bitcoin's its own coin, Solana is a coin, and Ethereum is a coin. A token lives on another blockchain. Like altcoins and meme coins and mostly new projects are all tokens. Why does this matter? Well, coins, they have better security and long-term infrastructure, whereas tokens, they're more manipulatable, easier to make, and easier to rug pull. Now, what I'm saying is that tokens aren't bad, you just have to be a lot more careful when trading and playing around with them. Next is slippage. Slippage is the price you expect versus what you actually get. So what is high slippage? Thin liquidity, volatile trading, and potential manipulation. If you try to buy $500 worth of something and the price jumps up 10%, that's slippage. Or even if you tried to sell something and the price collapsed instantly, that is also slippage. Extreme slippage is common in scam or low quality tokens. Now let's talk about whales. Whales are wallets holding very high supplies of a token or a coin. A few things that whales can do if they have enough of a token is control the price, manipulate pump and dumps, and scare people into panic sells. That is exactly why top holder percentage matters a ton. If the top 10 wallets hold over more than I'd say 20%, then it's pretty dangerous. Now, this is pretty important to know. It's circulating supply versus total supply. Circulating supply is what can be traded right now, and the total supply is what's already out there or plans to be out there. So if like only 10% of a token was out there, eventually the other 90 will come eventually. When tokens unlock, early investors, teams, and VCs can sell, and that pushes the price down. That's why you always need to check these 3 things. How much of it is circulating, how much does the top 10 holders own, and how much is unlocked right now. Now, let's talk about block layers. You'll hear people talk about layers 1, layers 2, and sometimes even layers 3. Here's what they mean. First is layer 1. This is your base blockchain. Coins like Bitcoin, Solana, and Ethereum use them. They're used for the final transactions and security. Next is layer 2. It's built on top of layer 1 to make it faster or cheaper. Coins like Arbitrum and Optimism use this. They process transactions faster and then settle them back onto layer 1. And now layer 3 is usually just app specific. It's used on like games, DeFi apps, and niche cases. So why does this matter? Layers 1, they try to be the foundation of crypto. Layers 2, they fight to be more efficient with cost or speed. And layers 3, they live or they die by the hype. Now let's talk about full diluted valuation, or you'll hear FDV. Fully diluted valuation assumes that every single token that exists is already in circulation. So why does FDV matter? A coin or a token can look really good with a $50 million market cap, but could have a $2 billion FDV. That just means a massive dilution is coming. A low market cap with an insanely high FDV is a massive red flag. It generally just means that there's going to be a future sell pressure coming. Our last two terms apply to more than just the markets. These can be used in real life too. The first is do your own research, or DYOR. Doing your own research isn't just going on X and reading tweets or just a light scratch at the surface. It means a few different things. Understanding tokenomics, watching liquidity, knowing the supply and the unlocks, and knowing who benefits when prices move. If you don't understand where money flows, you are the money flow. And our last thing we're talking about today is the fear of missing out, or sometimes called FOMO. Now this is where people really lose money. FOMO isn't excitement, it's panic disguised as confidence. FOMO occurs when the charts are going vertical, X is erupting, you feel late, or you feel like you're the only one missing out. Here's the issue. If you're buying because you feel like you're missing out, someone else is selling because they plan this very moment. FOMO really happens when there's viral hype, the risk looks invisible, or the coin just 2 or 3x'd. And that is exactly when you become the exit liquidity. If you feel rushed, pressured, or emotional, that's not opportunity, it's just a setup. The market doesn't reward urgency, it rewards the patience. If you miss a move, just let it go. There will always be other opportunities. If you're chasing pumps, your portfolio most likely will die. Crypto rewards the people who understand the rules before playing the game. If this video was able to help you from one bad trade, it already did its job. If you made it to the end of the video and have any questions, leave a comment. I respond to every single one.